Hello everyone. Now this is something that is very important for your examination. How to calculate NOPAT, net operating profit after tax. Now ICAI in its main study material hasn't given the calculation part of it. But they have asked few questions in the study mat at test your knowledge that requires you a detailed knowledge of how to calculate NOPAT. So in this video, we will deal how to calculate NOPAT. Now this is very important for A, whether you have examination in the coming future, or B, you're preparing for a long-term goal. Either way, you need to see this video. This is very important. Now understand, I am specifically doing this video in English because there are some students down south, the south cadre of students. For them, Hindi is their second language or Hindi is not their preferred language, so they get a little uncomfortable. So it's time we switch to English and we do it so that the mass gets the benefit. Okay, understand the part now. Now, before we start, for EVA, you need to understand three main adjustments which are there for EVA. Okay, the first one, let me deal with the first one. Okay, wait a sec. Now, I would recommend you write this while the video. While among the most common and important factors for EVA are, now you know what is EVA, how to calculate NOPAT. For EVA, you have seen that video, okay, revision video. Expenditures on R&D, research and development, promotion and employee training. Always understand these three will always be capitalized. Whether question specifically says or not, you have to capitalize these three expenses. Okay, understand this part. Okay, sir. These three needs to be capitalized. Now, for EVA, for NOPAT to be specific, we first take EBIT. Okay, we have EBIT, earning before interest and tax. Yes, sir, we have EBIT. Now, first in EBIT, we add every capital expenditure. Let me write it as capex. Okay. Take every capital expenditure, capex, we write that. Now, next, every capital expenditure, I am again stating this. One more things come under capital expenditure, especially only exclusively for NOPAT, and that is operating lease. What? Sir, operating lease. Indeed. What comes? Sir, one capex and plus operating lease. There are two types of lease you might be knowing, operating and financing lease. I won't be getting into details of both those types of lease because that is something that you learn in India's 1116 financial reporting subject. But understand, there are two types of lease, operating lease and financing lease. If it's given financing lease, ignore that part. If they have given operating lease, add the expenses of operating lease to your EBIT. Have you got this part? Yes. Next. So this is the other part. Should be capitalized and added back to capital employed. Eventually that capital employed, all capital expenditures are added. So we add that. Okay. Now this is an important part. You know, when we calculate earning before interest and tax, what we do? Earning less all the expenses. Yes, sir. So one expense that we specifically deduct is depreciation. Yes, sir. We specifically deduct depreciation. So we deduct depreciation. Now there are two types of depreciation for this particular concept. Economic depreciation and accounting depreciation. Now what are economic and accounting depreciation? Let me tell you. For example, this is a particular controller. And this is, take this into consideration, this is a tab that I have. Okay, this is one tab which I have. Okay, now understand. These tab, let's take into consideration, as per income tax, depreciation is 60%. Okay, and we follow the income tax rate, schedule 2 income tax rate. So this is accounting depreciation 60. But economically, what is happening? Understand this. Since mobile technology is evolving so rapidly that this year's tab would have nil value next year. Understand this. This is pretty common in mobile technology. Yes. So economically, this tab should be depreciated 100%. Because practically from next year, it won't be of any suffice for my company. Now, for net operating profit, this is different from accounting profit. We don't take accounting depreciation because it is merely for book entries. It is merely for knowledge purpose. This is something which is happening in reality, and this is what we need to take. So what we will do now from EBIT, what we will do? From EBIT, we will deduct economic depreciation. Don't worry, this would be given in the question. Okay, and we would add accounting depreciation, because for calculating EBIT they would have deducted certain depreciation which is in the books of account. We would add back and deduct this. Okay, then now, okay, and now all other non-cash expenses like provisions, allowances, doubtful debts, deferred tax provisions. And for deferred tax provision, underline this part. I will teach you this differently when I'll teach you what happens of tax expenses. But other provisions such as allowance for doubtful debts, allowances for inventories, or any other non-cash expense. I'm specifically non-cash provisions, which does not involve, and provisions means something that has been not associated with cash. So all those non-cash expenses would be added back. And see, provisions would be added back. Okay. Then next part. Okay. Non-cash expenses. I have said that provisions and non-cash expenses would be added back. This is clearly mentioned. Now understand. This is very important regarding the tax charge. Now let me explain you this tax charge principle. Before that, let us recapitulate what we have done up till now. We have earning before interest and tax. Yes. Sir, we add all those capital expenditure which were shown, especially R&D, R&D, employee expenses, promotion training, employee R&D training. All these are added, and I'm specifically telling employee training should be added. If you have given bonus to employee, that is your regular expense, that won't be taken into capital expenditure. Understand the words employee training. Then depreciation, I've told you there are two types of economic depreciation and accounting depreciation. You eliminate the accounting part and you add the economic part. Then all provisions and non-cash expenses will be added back. Operating lease, it's a kind of capital expenditure, so it will be added. Financing lease, we will ignore it. Now get the third part. Tax charge. Now understand this. Tax charge is an important concept. Now wait a second. During question, institute will give you tax paid. What will they give you? They will give you tax that is paid. Okay, tax paid expenses. Yes, sir. Now, when ICI gives you tax paid expenses, how you will deal with it? Let me show. Now, for taxation also there are two types. Yes, sir. For taxation also there are one that is paid and one that is accounting tax. Yes. How do we calculate accounting tax? EBIT. For regular calculation, we minus the interest part and then EBT, and then we multiply it by tax rate. There comes a tax. This is percentage. This is simple. This is how we usually solve. Yes. Now, how you have to do it in this part. Okay. This is the bare statement, that way I have not changed, but I'll tell you a shortcut for this. The first thing is tax charge as per income statement. What is that? This tax. Yes. So this is tax. Then this is important. I specifically said na, I would be dealing with deferred tax provision. Here comes that provision. Increase in deferred tax provision. Now understand this part. If there is increase in the deferred tax provision, if there is increase, we will reduce it from our tax on accounting income. Okay, we will reduce. What will reduce? Increase in deferred tax provision. DTP? Yes. But what if there is reduction in deferred tax for certain reasons? You might have studied this in India's 12 deferred tax provision. Now, if there is reduction in deferred tax, we would add that. Okay. If there is reduction in deferred tax, we would add that. Just understand that this is, both of them don't come together. If there's increase in deferred tax, we would reduce it. If there's reduction in deferred tax, we would add that. Okay. Yes, sir. And then comes the third part. Plus tax benefit of interest. Now, what is this? Understand this part. Since you have reduced the interest part of it, there would be certain tax benefit. Let me tell you this by example. 100 rupees EBIT, 100 rupees EBIT. For both cases, this is with interest benefit, this is without. Okay. Yeah. Now understand. Interest is, for example, 10 rupees. Yes. Here we will not take any interest. So what is my income? Sir, 90 rupees. And here 100 rupees. Yes, sir. Now tax. Let us consider at the rate 30%. So tax would be 27 rupees here, and here would be 30 rupees. There is an increase of 3 rupees. How? 10 into 30% becomes these 3 rupees. So you are paying a reduced tax, a less tax. Why? Because you have interest expense. So there is a benefit of interest expense. Yes, sir. So what you need to do? You need to add that interest benefit. Now this is the bare act that is saying. What I say is, rather than calculating this tax, why don't you simply do that? EBIT into 1 minus tax. EBIT into tax rate. EBIT into tax rate. If you solve directly this, these two steps need not be done, and this would be your final amount minus this provision. How, sir? Let me tell you. Let us take this same example into consideration. Let us take this same example. What you would have done for this? You would have taken 27 as tax. Yes, sir. Plus, let us understand, right now there is no increase, no decrease. So this is 0, deferred tax provision. Plus, so what is the interest part? What is the interest part, sir? Sir, what is the interest part? Let me tell you what is the interest part. Yes. Now, interest saving is 10 into 30%, that is 3 rupees. Yes, sir. So that comes 30 rupees. Yes, sir. And if you directly take EBIT into tax, that is 30%, that would be 30 rupees. Yes. So I recommend this. Like Virat Kohli recommends MRF as, this is what I recommend. That you simply do 30 rupees. You have got this part? Yes, sir. Now why is this? And what do you do of this tax here? You reduce this tax expenses that is calculated via this. So you reduce these taxes. So please note down this particular thing. And then we will see a question of ICI. I'll not, capital employed is something that you know. You have studied that very good in SFM. This is something that is not so much into SFM. That's why we are dealing it here. Now let me show you an example. Okay. Your study mat, question number 4. Okay, this is that question. Wait. Clear page. And clear the page. So get this question right. One of the most important questions. This question was asked also in, I guess, November 20 examination. Now understand. Operating profit. Operating profit is your earning before interest and tax, because they specifically said finance charges. Finance charges are your interest expenses. That's the terminology. Now operating profit is 162. So earning before interest and tax is 162. Let me write it with blue color. Okay, 162. Yes, sir. Then leave finance charges. Now what is the other? The capital expenditure. Now audited accounts, this is the capital employed. Understand, this is the capital employed, not the capital expenditure. Understand, this is the total capital employed. This has nothing to do with our EVA part, please. Okay. Now operating costs do include depreciation. What have I said about depreciation? Sir, we will remove the accounting depreciation and we would add the economic depreciation. This is operating cost. So what is this? So this is accounting depreciation. So we will add accounting depreciation of 118 rupees. Yes, sir. Then provision for doubtful debts. Every provision comes. Yes, sir. So we will add provision for doubtful debts. That is 4 plus research and development. I have said irrespective of whatever the question says, R&D is your capital expenditure. So it will be added. Other non-cash items, all these 3 items will be added. So that will be 4 plus 24 plus 14. That is 4 plus 24, 28, 42. So 42 will be added prima facie. Yes, sir. 42 will be. Okay. This is 4 plus 24 plus 14. Yes, sir. Okay. Yes, sir. Then these 3 are added. Economic depreciation. Now this is important. Economic depreciation is 166 crore. So what do? We reduce the economic depreciation. So that's why less economic depreciation, 166. Okay. Then operating lease is not given. So that's why it's not given. So that's okay. And capital expenditure, we have quoted this exactly here. We have quoted it below. Yes, sir. Now what? Now understand this part. Research and development has been non-capitalized. We have said that irrespective of whether it is capitalized or non-capitalized, we will take it as capital expenditure. That is important. Yes, sir. Now understand this. Current tax years paid is 18 crore. That is not relevant for us. And deferred tax provision is 16.8 crore. That is relevant for a deferred tax. Now crore has been adjusted, whatever that is. There is no deferred tax balance before 2021. So basically the 16.8 has been made this year. So basically it is increased. Last year it was 0. This year it is 16.8. So now let us do the tax working. Yes, sir. What have I said for tax working? Let me erase this particular part for you. And let us do the tax working. Now what is the tax working? 162 EBIT. Yes, sir. What have I said? Multiplied by tax rate, which is in, I guess in this question it is 30%. So tax rate 30% would be multiplied. That is 162 into 30%. Wait a sec. Let me get the calci. So 162 into 30%. So this is 48.6. Yes, sir. What do we deduct from this? Sir, increase in deferred tax expenses. There has been an increase, so we deduct it. How much is the increase? 16.8, right? Yes. So less 16.8. Yes. Is there any tax benefit interest that we have already included into this part? Okay. Otherwise, what ICI has done? What ICI has done is ICI has taken this tax. Now, if you do that same thing, this is 34.8. Yes. And you add the interest benefit, that is 46 ka 30%. 46 into 30% plus 13.8 plus 34.8, that is 48.6, that is 48.6. That is same. You either do it that way or you do it this way. Okay, you either do it that way or you do it this way. Okay, then so this total tax expenses are 31.8. What have I said? We will deduct the total tax expenses. So less 31.8. Let me put it into bracket. 31.8. Now solve this. 162 minus 166 plus 118 plus 2. Okay. Now there is one thing that I think we haven't wrote, and that is, I guess, capital expenditure. Yes, wait a second. The biggest thing that we haven't wrote. Now understand this part. What have I missed? Wait. Now let us solve this calculation. We have wrote everything. There might be certain calculation mistake. Now understand this. 162 minus 166. No, this is not negative 42. This is 42 non-cash expense. Plus 118 plus 42 less 31.8. So NOPAT is 124.2. How much? 124.2. Have you got this part? Let us also cross check this from ICI. This is ICI's work. 124. So this is what I wanted to explain, how to calculate NOPAT. We have given it a good 18 to 20 minutes. Okay, this is how you calculate NOPAT. I will explain this question too. In this, after NOPAT, you have to calculate the capital employed. Now for capital employed, you will take the capital employed of last year. For example, in this question, let me say, what was the capital employed? The question, right? Yes. Capital employed, audited accounts. You will take off audited accounts because this is this regulator WDO. You have to see for ROCE, return on capital employed, not now. So you will take this is capital employed last year plus this year's capital expenditures. Now what are this year capital expenditure? First, provision for doubtful debts. Now understand this debt would eventually go into capital expenditure, so 5 for that. And non-cash items incurred in 19, 20, 12. This is given that these are of capital nature, so it will be incorporated. So therefore, we will get opening capital employed for this part. So therefore, into capital employed, that is it. And you will calculate the EVA, which comes negative. So EVA negative shows that there is decrease in net worth of an individual or of the shareholders that we need to cater. That is the same position that in this question WUS will be taking. Then you need to find regulatory return on capital employed. Now what is capital employed? Operating profit upon capital employed, and that is you will calculate. Remember one thing, that operating profit is given 95 and this capital employed is by regulator because it is specifically for regulatory purposes. That comes 6.8. They have said that acceptable is 7, so it is within the margin, nothing important. Operating margins you will calculate, that is simple. Operating margin is the profit that you are calculating, that is simple. You will calculate the operating margin, sales price, okay, contribution, and then you will find this, and this is quite simple. Overall, limited scope of increase the operating profit since maximum operating profit allowed is 97.4 crore. Why? Because 7% only operating profit is allowed. That is the regulatory rules. If you want to, that there are certain rules, okay, that you can employ certain capital and you can earn certain income. Because if you earn more than that, the regulator might see that you are doing unnecessary evil practices, or you are doing practices which are not good for the society as such. So these are some laws that are there for particular regulator. So you need to take into consideration that factor too. So basically this is a simple question. The only thing that was complex in this question is calculating of NOPAT. Based on this same principle, you can easily solve question number 8 and question number 5. Okay, question number 6 and 8. 6 is easy. Sorry, 4 and 5. What am I saying? For 4 and 5. 3, 4, 5. These are very easy questions. Now the trickiest part you have done. For this, you can easily calculate. See, operating profit. As I have said, all non-cash expenses. Everything capital expenditure will be added. Less tax and loss tax on benefit. We do a different working for tax that I have explained. I think you have got what I wanted to say. So this is your EVA and your 3 questions that I wanted to explain. And do say that all further videos, should I make it in English or should I make it in Hindi? Okay, thank you.